Hi guys, today I would like to talk about the current market of mortgage, which is very unique and has been around for a while, and the strategies we put in place for our clients based on this market, which allowed many of them to save more than 20% in interest. And personally, I implemented the same strategy for my mortgage as well. And what triggers me to make this video is the statement made by Mr. Philip Lowe, the governor of the Reserve Bank, before a parliamentary committee on 14th of August, talking about the outlook of interest rates for the next 3 years from RBA's policy perspective. Everyone turns to RBA for clues of future direction of interest rates. But this time is different. It is not just about a clue, rather a clearly laid out roadmap for up to 3 years from now. And it turns out that the strategies we put in place for our clients seem to be endorsed by the RBA, which is fantastic. Now, this is what in the statement about outlook of interest rates. What we can take away is that interest rate will not increase for at least 3 years, which is good news. But at the same time, the cash rate will also stay at the current level of 0.25%. And 0.25% is the floor rate RBA sets for itself as their policy. It seems that they have no intention to change this policy, as they set a target of 3-year yields at 0.25% to reinforce it. Just as a proof of this intention, RBA decided to hold the cash rate this month as we expected. And the statement released soon after that reaffirmed what Mr. Lowe said in the parliament. We know banks link their variable interest rate to RBA's cash rate. With the cash rate put on hold, variable interest rates will stay at the current level as well. Depending on the lenders and the type of mortgage, we can get variable rates from 2.5% to 3.2%. And 3% is the benchmark rate. Interest rate is not the only weapon RBA has to manage the economy. Quantitative easing, or simply printing money in layman's language, is a more direct and effective way to stimulate the economy. And one of these programs is a 3-year funding facility at 0.25% made available for the banks to lend for mortgage. This money is almost free of charge for the bank. But the catch is that they can only use this money for up to 3 years. This is the reason we see all the banks offering fixed interest rate loan products up to 3 years at very low rate from 2.1%, because they can't use this money for other loans. I used 2.3% as a benchmark in this discussion. The question is now, what is the best strategy of mortgage under the market like this? Just by looking at this slide, it is obvious that fixed rate will cost you less than the variable rate. Let's take a look at an example and see how much you can save with this fixed rate. For a loan of $500,000, the interest cost is $1,250 per month at a rate of 3%. If you use a fixed rate of 2.3%, the interest will reduce to $954. Out of sudden, you will save $296, which is about 23% lower, or around $3,500 a year. If you lock this rate for 3 years, you will save around $10,000. That's why I call the gap between variable and fixed rates saving zone. A home loan is not just about interest rate. A carefully planned and balanced loan structure with the right features is always our first consideration. But the current market does give us a unique opportunity to implement a good strategy with the lowest ever interest rates. Let me share the strategy we put in place for our clients at a high level. First, this strategy is not about to set up a loan, forget about it, and let it run for 30 years. We look at the current market and plan it for up to 3 years from now. Secondly, we recommend locking into a 2 or 3 year fixed interest rates for the majority of your loan to take advantage of its low interest rate. Of course, if the fixed rate is suitable for you. The remaining loan in variable rate will allow you to continue to enjoy the flexibilities such as additional repayments and offset account. We always negotiate the lowest possible interest rates with the lender of our choice. The proportion between fixed and variable rates needs to be analyzed and calculated carefully based on individual situation to achieve the best outcome. We will have many variations based on this basic setup, but the principle is the same. This structure will give you the most cost-effective loan solution for next 2 or 3 years. The last but not least is a reviewing process after the fixed rate term is over. Our post-settlement care program will take care of it. We will review your loan against the market at the time and make recommendation accordingly. Your mortgage needs to be kept up to date with the changes of market. Just like a car, you need to maintain and tune up regularly to make it run smoothly and efficiently. This strategy is made of a series short-term loan solutions with a long-term action plan. The goal is to achieve the maximum cost savings by setting up and adjusting the loan structure following the changes of market condition. This strategy works well no matter you want to set up a new mortgage to buy a property, change your loans with your existing lender, or refinance to a different bank for better deals. We can always find the best suitable lenders and loan products to implement this strategy. And we still have some generous cashback incentives available up to $3,000 for refinancing. But this window of opportunity is closing very quickly. So I encourage you to give us a call and start a conversation about the best strategy and loan solution for your requirements, while this unique opportunity is still available. That's all for today's video. If you find it helpful and makes sense to you, please like and share this video. Thank you for watching. See you next time.